Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is August 18 and this is a weekly markets update. Let's have a look at the news of week 33 and see what are the next trends. Also, please check out my interview with Harry Morton, head of low carbon at Itasca, published last week. Harry shed light at a very interesting and important topic related to green transition in fertilizers, so don't miss the jazz. India continues to rock. Last week, we discussed with you the final results of the latest Indian tender, where IPL bought 2,075,000 tons of urea. Then we also discussed that the timing of the next Indian tender will be the key for further price dynamics in the market. And, surprise, surprise, India decided not to wait and try to catch lower price for the next tender, but rushed immediately in the next tender. On Friday, NFL has issued a purchase tender for a total of 2 million tons, 1 million each for East and West Coast. The tender closes on September 2, and shipment is due by 31st of October. Why to rush so much? Low stocks and quick pace of their depletion is the answer. Despite India was able to secure 3.6 million tons in the last two tenders, these tons will not arrive earlier than September and will reach farmers even later than that. Hiccups with previous tenders when India was not able to secure enough volume resulted in stocks as low as 3 to 3.5 million tons. Valuations vary. Moreover, the stocks are unevenly distributed in the country, and some regions seem to suffer from deficit. Taking into account how politically important urea supply question is, it becomes clear why Indian government decided to prioritize quickest possible supply to price. In terms of expected price level in this fresh tender, I would assume that suppliers will try to keep the maintained price level. I believe it will be not that easy, because the level achieved was extraordinary. But figures close to those we might see. How it will influence global market dynamics? Last week, my guess was that between mid-August and mid-September, when the next Indian tender was expected, market will see downward price correction. However, now it is clear that September demand is well supported, so the correction will not happen until first decade of September, perhaps. However, correction is still inevitable because supply will pressure limited demand at the end of Q3 and in Q4. So we are back to square one. When the next Indian tender is going to happen and how large will be Brazilian demand in October onwards. As we discussed last week, India needs to purchase around 5 million tons more until the end of the year. If they purchase the targeted 2 million tons in the tender announced last Friday, they will have 3 more months in Q4 to purchase and ship the remaining 3 million, which is very doable and means tenders might appear, say, October and November. It means that correction is postponed to September. Let's keep watching this never-ending Indian series called tendering in 2025. Before tender announcement on Friday, prices slipped everywhere across the globe, and purchasing activity was very scarce. Europe continues to be focused at harvesting, thus no fresh sales from Egypt or Algeria emerged. Demand in Turkey was almost absent, with target CFR level indicated around $480 duty unpaid, but no actual purchases. Iranian producers have set target FOB price level at $440 and had a number of tenders. However, none of the tenders ended with sales. Some of them were scrapped, others still not, but perhaps will be scrapped later. Consistently high target FOB level has led to overstock, and I would assume that producers will need to either drop their target sometime soon or they will be forced to stop production. You cannot store hundreds of thousands of tons of urea during summertime in Iran, especially in port warehouses with high humidity without guaranteed product deterioration. So let's see how the situation unfolds. In Brazil, affordability continued weighing on market activity, and prices slipped to $475 to $95 CFR for non-Chinese products. There were only several deals registered and sentiment is soft. Chinese product is offered at much lower level, around $460 CFR, but it doesn't provoke much interest. Interesting question is if China will participate in the fresh Indian tender, and if yes, how much volume it will send there. This factor will be very important for short-term market dynamics. As of October, China will be out of the export market, so this tender is actually the last chance for Chinese producers to massively export. Paper values move differently for different benchmarks. Egypt FOB and Arab Gulf FOB values corrected upwards for August and 2 months ahead, amid anticipation of squeezing supply due to fresh Indian tender. Brazil CFR significantly dropped by $12 for August and September and by $5 for October due to affordability issues influencing purchase sentiment. Same reason caused decrease of non-FOB values. Ammonium sulfate market was subdued with very low purchasing interest anywhere across the globe. Thus, Chinese FOB values again corrected slightly downwards. Copper crystal product was indicated at $160 to $65 FOB, while granular at $170 to $75 FOB. Still, Brazilian buyers didn't show interest, as their stocks are high and no need to rush for immediate purchases. Nitrates market continued to be almost absent. In theory, soon after harvesting, purchasing demand should revive, but current high price level doesn't trigger activity. And suppliers are not willing to drop prices for now. In Poland, Grupa Azoty, after raising list prices a week ago, last week started offering very good discounts to distributors on these list prices. So generally prices have started to drift lower. In the UK, Yara announced new prices for August, September and October. For ammonium nitrate, it is steady at 380 pounds delivered, while for September and October, price will increase by 3 and 6 pounds, respectively. Prices in Baltic slipped, but more demand for supply of 12,000 tons to Romania in September was circulating, without any firm details. In the US, focus last week was on UAN summer refill program pricing that was issued on Monday. August to September barges were offered at $305 FOB NOLA per short ton. The price is about $100 more than a year ago, and volumes offered by producers are much less due to low imports and, as a result, low post-season stocks in the market. In the ammonia market, prices largely unchanged, as spot demand was pushing prices up. However, improving global supply will not let the price increase, in fact. Algerian production was resumed last week, so the supply west of Suez as of end August will improve. Egyptian production is also ramping up, and recently installed LNG regasification facilities are expected to improve production stability in the future. Most of the buyers in the region are covered for August, so there is no need in overpay for September cargoes. Turkey is waiting for 3 Iranian cargoes that will arrive this week. In the US and Trinidad, there are no production issues as well. Mainly contract shipments are ongoing with no spot activity registered last week. Price level remained unchanged. East of Suez production is running stable, so market remained balanced and price unchanged last week. Indian spot demand is absent for now. Market expects it to revive maybe in September. In phosphate segment, prices remained unchanged, mostly due to India holding firm to its previously announced cap of $810 CFR. Last week, Russian DAP cargo of 35 to 40,000 tons was sold at the same price again. Also, Hurl announced a tender for supply of 50,000 tons of DAP that will close on Thursday. Bangladesh tender is moving. ABC has issued counters at lower level versus initial suppliers' proposals. Responses timing was due yesterday. The target for Chinese origin was indicated at $848 CFR, for Moroccan, Jordanian and Egyptian origin at $874 CFR. Also, lower targets were put for TSP and SSP. We will know tender results later this week. In China, the focus is also on Bangladesh as supply remains tight. Market doesn't expect more export quotas to emerge, so availability concerns will persist. DAP offers level will rise from $790 to $820 FOB, depending on the market, but there are only limited offers. In Jordan, a sales tender for 45 to 50,000 tons of DAP closed last Tuesday, but the result is still awaited. In the US, DAP price at NOLA fell after issuance of August WSD report, which confirmed high corn production and which resulted in corn future price decrease. NOLA barge price for DAP dropped by almost $17 last week and reached $787 to $95 FOB per short ton. Affordability tightens further, and there might be more farmers who will seriously think about skipping autumn application. US DAP imports for the first half year of 25 dropped by 28% versus a year ago to less than 1 million tons. Same reason limits purchasing activity in Brazil, where no fresh deals were registered last week. Moving to the fundamentals. European natural gas futures dropped to less than 31 euros per megawatt hour on Friday ahead of Trump-Putin summit aimed at ending the Ukraine war. There was no concrete outcome of the summit yet, but the direct meeting between President Zelensky, President Trump, and Putin is anticipated maybe as early as this week. So the tension is incredible. For a quick return of Russian pipeline gas is unlikely. Any change to sanctions could reshape global supply. Europe now relies mainly on imports from the US, Qatar, and others, competing with Asia for LNG cargoes, with Russian supply under 20% last year. Sanctions relief could revive Russian LNG projects, easing supply pressures. Meanwhile, EU storage is nearly 73% full already. US natural gas futures dropped slightly versus a week ago to $2.92 per MMBtu. Energy Information Agency storage built well above seasonal norms, leaving inventories 7% above the 5-year average. The output hit more than 108 billion cubic feet so far this month, topping July's record. At the same time, LNG feed gas flows also increased so far in August versus July. Weather is expected to stay hotter than normal through late August, though Tropical Storm Erin, which is forecast to become a major hurricane en route to the Bahamas, could cool the US East Coast and disrupt conditions. Agricultural commodities future prices were again in the red zone last week. Wheat futures touched the bottom last week at less than $5 per bushel, but then finished the week at $507, supported by both market fundamentals and geopolitical developments. USDA has projected in its August report issued last week slightly tighter 25-26 US wheat supplies, with production down 2 million bushels due to a smaller harvested area, despite higher yields. Still, abundant Northern Hemisphere harvests, particularly from Russia, the EU, and improving crops in Australia and Argentina, are pressuring global prices. Current price level was not seen since September 2020. Also, traders closely monitored US President Trump meeting with Putin, as both Ukraine and Russia are major grain exporters. Corn futures also touched the lowest point in past almost 5 years last week, but by Friday rebounded to $3.84 per bushel, as fears of an unabsorbable US harvest eased, supporting higher forward prices to sustain demand from ethanol producers and feed markets. While the August WSD maintained a record US crop estimate, attention shifted to hotter and drier less season weather in parts of the Western Corn Belt, raising yield risks during grain fill and eroding confidence in trendline yields, as reflected in private forecasts and softer USDA crop condition ratings. Weekly US export sales also surprised to the upside, with combined old and new crop commitments nearing 2 million tons, the strongest in weeks. Beyond the US, the supply outlook appears less secure than midsummer projections implied, with Brazil still moving a large safrinha crop, but Argentina's 24-25 harvest already reduced and export flows uneven. Soybean futures rose sharply from the lows of a week ago and reached $10.23 per bushel, as the market remains focused on the supply and demand scenario in the US. The USDA's August report cut US production about 2% below trade estimates, reflecting lower planted area despite improved yields. The USDA also lowered its forecast for US soybean exports in the upcoming season, amid ongoing uncertainty surrounding demand from China. On August 10, President Trump called on China to quadruple its soybean imports before the tariff truce deadline, which is unrealistic as per analysts' estimates. For now, China continues to source mainly from Brazil and still needs to secure significant soybean volumes for October and December delivery. Moving to the shipping industry. Containerized freight index continued its slow but steady downward correction and lost another 90 points during last week. The sharp decrease that was observed until mid-July slowed down. However, the trend is still downward. Trans-Pacific spot rates declined by 2 to 5% last week, depending on the route. China to Europe rates also dropped by 3%. General expectation in the market is unchanged. Spot rates will continue declining further during this year. The Baltic Exchange Dry Index hovered at the level similar to a week ago. The Capesize market held broadly steady, moving within a narrow range as sentiment shifted between softer patches and bursts of firmer activity. The Panamax market provided mixed returns with contrasting fortunes in both basins. While in Atlantic, shippers saw sizable losses, Asia witnessed a week of steady gains, with stable demand led by Indonesia coal, duly supported by decent demand ex-Australia. The ultra-supramax segment, the US Gulf, saw some stronger numbers being achieved with a good amount of fresh inquiry. However, the South Atlantic failed to attract much attention and rates eased generally. For Handysize segment, the week was mostly uneventful. To sum up, India continues surprising the market. The fresh tender that seeks for 2 million tons with shipment window until end of October appeared immediately after finalization of the previous one. Clearly, this move will support price trend until the middle of September. However, downward price correction is inevitable and will just be postponed. The key question still is if China participates with more tons this time, as shipment window coincides exactly with closure of Chinese export window. Elsewhere, the purchasing activity was subdued, with affordability seriously limiting purchasing appetite of the next most important market, Brazil. The same reason kept activity in ammonium sulfate segment almost non-existent last week, with price going down in China. Ammonia price remains stable both west and east of Suez, amid healthy supply from all main producers and stable demand, absorbing these tons for now. Phosphate prices kept stable for the third week in a row due to India being firm in its decision to put a cap on its purchase price. The market is watching situation around Bangladesh tender evolving as ABC issued counters at lower level versus suppliers' offers, and now awaits confirmations. Additional export quota from China becomes less and less probable, so supply will remain tight in the near term. Natural gas price, both in Europe and the US, dropped due to healthy supply, as well as an anticipation of negotiations progress between US and Russia regarding peace deal in the Russian war against Ukraine. After issuance of August WSD report, future prices of wheat and corn dropped to 5-year lows amid forecasted very ample supply. At the same time, soybean price rebounded from the lows of last week due to cut in US harvest estimates. Container shipping rates continued downward correction, while bulk shipping activity was rather positive across all segments and basins. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.